We're back to cut through the noise and tell you what actually moved markets this week. Forget what you've heard on CNBC, Bloomberg, or those echo chamber finance pods. This isn't two economic journalists chatting, and no, we're not interviewing a hedge fund billionaire. This is something totally different. It's a raw, real-time debrief between two AIs, both trained by a former top-tier institutional portfolio manager, breaking down what really moved global markets. Markets were jolted as U.S. stocks whipsawed on fresh tariff threats and a surreal Greenland standoff, even as GDP was revised up to a blistering 4.4%, forcing investors to confront growth that's almost too hot to handle. Gold ripped toward 5,000 USD as inflation stayed sticky at 2.8%, signaling deep skepticism about policy stability. Europe wobbled under trade fears and a UK inflation shock that's boxing in the Bank of England. And in Asia, Japan triggered a bond market revolt with a surprise fiscal gamble, while China quietly hit its growth target, masking a historic slowdown under the hood. Before you chase the next breakout or macro trade, pause. Let's unpack what the data is actually whispering, not just what the headlines scream. Like, share, and subscribe if you want real insights, not recycled takes. And stick around, because at the end of this episode, we're dropping the top 5 global risks that could blindside markets next week. You do not want to miss this.
So if you thought January was going to be a slow, comfortable ease into 2026.
A gentle start.
Exactly.
Yeah.
Well, I have some terrible news for you. You were dead wrong. Welcome back to the Deep Dive.
Mm-hmm.
We are not just reading the headlines today. We are reading the riot act on the global economy. I'm talking about a week so weird, so disjointed, that we had a diplomatic standoff over buying Greenland again
Yeah.
while gold prices were, knocking on the door of $5,000. And Japan threw a fiscal curveball that has bond traders literally sweating through their suits.
It really was one of those weeks you have to check the calendar to make sure it's not April 1st. But, looking at the stack of sources we have, the mission is pretty clear.
Bitches.
We need to cut through what I'd call the geopolitical theatrics, because underneath all that noise, the tariffs, the islands, there is some serious economic machinery grinding away.
Yeah.
And we're seeing this massive divergence.
How so?
Resilient, almost stubborn growth in the U.S. versus, deepening structural cracks in China and some sudden self-inflicted panic in Japan.
It feels like the world is split between too hot, too broken, and just plain confused. So here's the plan. We're going to take a tour of the globe.
Right.
But we're not just going to list GDP numbers. We're starting right here in the U.S. with growth, that bizarre Greenland story, and the gold rush. Then we'll hop the Atlantic, see why Europe's nervous, do a serious deep dive on the UK's inflation nightmare, and then Asia.
For the Japan shock and China's slowdown. And we have to leave plenty of time for the look ahead, because next week is the Fed decision.
Oh, absolutely. We are ending with a major preview of next week's massive Fed decision and our top 5 risks checklist. And listeners, do not skip that part. This isn't just a list. It's a survival guide for next week.
I'd argue that's the most critical part of this deep dive. The market is pricing in, perfection, and next week could easily shatter that.
All right, let's get into the machinery. We have to start in the United States. And honestly, I feel like I'm in a time machine.
Yeah.
The Greenland Gambit. I opened my news feed on Tuesday, saw tariffs and Greenland in the same sentence, and I thought I was hallucinating. President Trump announces new tariffs on Europe amidst a diplomatic spat over buying Greenland.
History doesn't repeat itself, but it certainly rhymes. Look, on the surface, it sounds absurd, but the market reaction was immediate and visceral.
It was sharp.
When that headline hit on Tuesday, the S&P 500 had its worst single-day drop since last October. It was a flash of pure uncertainty. You have to remember, algorithms and traders, they don't analyze the logic of buying an island. They analyze the volatility of the person in charge.
It was a flash crash, basically. But then by Wednesday, it was like it never happened. The market just rebounded. So was Tuesday just a temper tantrum?
In a way, yes, but it highlights just how fragile the sentiment is. The reason the market could bounce back, though, is because if you strip away the politics, the underlying fundamentals in the U.S. are actually incredibly strong.
Shockingly strong.
Shockingly. I mean, you look at the GDP revisions that came out this week. Third quarter growth was revised up. We are talking about 4.4% growth.
4.4%. Wait, let's pause there. In this interest rate environment, with rates this high, how is the economy printing 4.4%? That sounds fake.
It does sound like a typo, doesn't it? But it's not. And here's the important part. It wasn't just fueled by Americans racking up credit card debt. It was driven by exports and investment.
So real economic muscle.
Exactly. Companies are spending money to grow. And then you look at the labor market. Jobless claims are holding steady near historic lows around 200,000. So if you ignore the political headlines for a second, the U.S. economy looks like a powerhouse.
Okay, play devil's advocate for me. We can't have 4.4% growth and full employment without paying a price somewhere. There's no free lunch in economics. Where's the catch?
You're right, there's no free lunch. The bill is coming due in the form of inflation. That's the bad news lurking in the data. The core PCE,
The Fed's favorite number,
the one they watch like a hawk, it held steady at 2.8%.
which is still well above their 2% target.
Exactly, and that is the problem. You have high growth, low unemployment that fuels demand, which keeps prices sticky. And the consumer is feeling it.
I bet.
We saw the University of Michigan Consumer Sentiment Index tick up slightly to 56.4, but let's be real, that is still 20% down from where we were a year ago.
Right, because even if you have a job, paying 30% more for groceries than you did 3 years ago just feels bad.
Precisely. People have income, but they don't feel wealthy because the purchasing power of that income is just eroded.
Speaking of purchasing power, let's talk about the shiny objects. This is the other thing that blew my mind this week. Metals mania. Gold surged to nearly $4,980 an ounce. We're basically at $5,000 gold.
And silver over 100.
Silver topped $100 an ounce. Now, if the economy's growing at 4.4% and everything's awesome, why are people hoarding gold bars?
That is the ultimate contradiction, isn't it? Usually you buy gold when you think the world is ending, not when GDP is booming. But here's the synthesis. It's fear. When you see gold hitting 5,000 and silver at 100, that is a hedge.
A hedge against what?
Investors are looking at the Greenland spat. They are looking at sticky inflation at 2.8%. That won't go away. And they are saying, I need insurance.
So it's a vote of no confidence.
It's a vote of skepticism. They're betting that the Fed can't fix inflation without breaking something else, or that geopolitics is about to get much worse. It's the market saying, I like the growth, but I don't trust the stability.
The engine is running hot, but the passengers are putting on crash helmets just in case.
That's a perfect visual. And that resilience in the U.S. is exactly what's complicating things for the Fed. They can't cut rates aggressively to help the consumer when the economy is growing at 4.4%. It just ties their hands.
Which brings us perfectly to the other side of the pond. If the U.S. is a Ferrari running red hot, Europe feels like a sedan that's struggling to start. Markets over there didn't have a great week, right?
No, they didn't. You saw the DAX in Germany down over 1.5%. The mood is anxious, and a lot of that anxiety is imported.
From the U.S.
We mentioned the U.S. tariff threats earlier. That hits Europe hard. But there's also the stalled Mercosur trade pact with South America. Europe is an export-driven economy, and when global trade barriers go up, Europe suffers disproportionately.
They're caught in the crossfire. But is it just trade wars? What about the actual health of the economy itself?
It's a mixed bag, which is just frustrating for policymakers. On the positive side, the Eurozone PMI held at 51.5. Now, just a reminder, anything above 50 means expansion, so technically they're growing.
Modestly.
Very modestly. And business optimism actually hit a 20-month high.
So corporate leaders are feeling somewhat better.
They are, but it's a fragile optimism. It's like they're seeing sunlight, but they're waiting for the thunderstorm. And if we zoom in on the UK specifically, the contradictions stop being mixed and start looking dangerous.
Yeah, let's dig into the UK, because I saw some numbers that simply did not make sense to me. It looked like the definition of stagflation.
It is getting uncomfortably close to that label. Here's the conflict. On one hand, the UK composite PMI jumped to a 21-month high of 53.9. That sounds great, right?
Sounds like a boom.
But then you look at the labor market, unemployment hit a 5-year high at 5.1%.
Wait, how does that work?
Yeah.
Businesses are busier than they've been in 2 years, but they're firing people.
It suggests companies are squeezing more productivity out of the staff they have, or they're automating, or they're just plain afraid to hire because of costs. But the real picker for the UK, the thing that keeps the Bank of England awake at night, is inflation.
Right.
The UK CPI rose to 3.4%.
That is way higher than the U.S., and what's driving it?
It's frustratingly specific. Airfare and tobacco prices.
So expensive vacations and smoking, that's what's breaking the economy.
Essentially, yes. But the consequence is serious. With inflation at 3.4%, the Bank of England cannot cut rates. They are stuck. So you have rising unemployment, which usually screams cut rates to save jobs.
Right.
But you have rising inflation, which screams raise rates to kill prices.
They are completely painted into a corner. If they cut rates to help the unemployed, inflation explodes. If they raise rates to kill inflation, unemployment explodes.
Exactly. It is the central banker's nightmare. Europe is walking a tightrope, but the UK is trying to walk that tightrope while juggling flaming torches.
Not an enviable position.
All right.
All right, let's fly over to Asia. And honestly, if Greenland was the weirdest headline, Japan was the biggest shock to the system. I mean, Tokyo usually gives us boring, steady news. Not this week.
Oh, absolutely not. This was a fiscal firestorm.
So, catch everyone up. Prime Minister Takaichi calls an early election. Standard political move. But then she pledges a 0% tax on food for 2 years. 0%.
It's a populist masterstroke. Free food, essentially, but economically it terrified the market.
Why? I mean, I'm not an economist, but cheap food sounds good for the consumer. Why did the bond market freak out?
Because there is no such thing as free. Japan already has a massive debt load, one of the highest in the world relative to its economy. When you say, we're going to stop collecting tax on food, you are blowing a massive hole in your budget. And investors immediately asked, how are you going to pay for this? And the answer is, we'll borrow more money.
So more debt.
Right. And this is where the bond vigilantes come in.
We hear that term a lot. Break it down for the listener who isn't a trader. Who are these vigilantes?
It sounds dramatic, but bond vigilantes are just investors, pension funds, banks, foreign governments who buy government debt. When they see a government acting recklessly with money, like cutting taxes with no way to pay for it, they protest by selling the bonds. And when they sell, the price goes down and the yield, the interest rate the government has to pay goes up. They are basically saying, if you're going to be irresponsible, we are going to charge you more to borrow money.
And they charged Japan a lot this week.
They did. The 10-year JGB, that's the Japanese government bond, the yields hit 2.26%. That might sound low compared to the U.S., but for Japan, that is a 29-year high.
Wow.
We haven't seen yields like that since the 90s.
So the market is punishing the prime minister for her popularity stunt.
Ruthlessly. And the central bank was caught in the middle. The BOJ left rates at 0.75%, but then Governor Ueda made some hawkish comments about watching yields closely. That caused the yen to whipsaw all over the place on Friday. It's just a mess.
So Japan is basically a case study in what happens when political ambition collides with cold, hard debt reality.
That is the perfect summary.
Which brings us to our final stop, China. The headline here looks like a victory lap. They hit their magic number. The 5% growth target for 2025 was met. Mission accomplished, right? Champagne corks popping in Beijing.
On the surface, yes. But if you look under the hood, the engine isn't just sputtering, parts are falling off. This is a classic case of hitting the target but missing the momentum.
Okay, break it down. Because 5% still sounds pretty good compared to Europe.
It is, but look at the trend. Fourth quarter growth slowed to 4.5%. That's the weakest in 2 years. But the stat that really jumped out at me, and I cannot stress this enough, this is historic, is fixed asset investment.
Okay.
It contracted by 3.8% for the year.
Contracted. Meaning they spent less on building stuff than the year before.
Yes. And that is the first annual drop in nearly 30 years. Think about that. Since the 1990s, China's entire economic model has been build, build, build. Roads, bridges, ghost cities, apartments. That era is officially over.
That feels like a massive structural shift. If they aren't building, what drives the economy? Is the consumer picking up the slack?
That's the hope, but the data says no. Retail sales were up only 0.9% in December. That is anemic. It's practically flat.
Oh.
The Chinese consumer is scared, their property values are down, and they aren't spending. The only bright spot was industrial production, up 5.2%, driven by exports.
So they're churning out goods to sell to the world, the same world that's putting up tariffs and fighting over Greenland because their own people aren't buying enough.
Exactly, and that is a dangerous vulnerability. They stuck the landing for 2025, but without massive new stimulus, the runway for 2026 is looking very short.
It sounds like they are running out of old tricks.
Yeah.
All right, that is the world tour. It's a lot to digest, but we can't just look back. We have to look forward. Next week, January 26th to the 30th, it is a monster week for data.
It is. If you're an investor, you cannot take your eye off the ball next week. This is where the rubber meets the road.
In the U.S., we have the big one. Wednesday, January 28th, Fed policy decision and the Powell press conference. What are we expecting?
Markets are universally expecting a pause. No rate cut. But the devil is in the details. Everyone will be parsing every single word Powell says. We also have durable goods on Monday and the producer price index, the PPI, on Friday.
And over in Europe.
Friday, January 30th, is the big day. We get Q4 GDP drops for France, Spain, Germany, Italy, and the Eurozone as a whole. This is the crucial health check. We need to see if that fragile optimism we talked about is actually translating into growth.
Or if the hard data shows a recession.
Exactly.
And Japan.
Consumer confidence on Thursday. Given the food tax drama and the bond yield spiking, it will be fascinating to see if the actual people on the street are panicking as much as the bond traders.
And China.
Surprisingly quiet week for data, which in China is often the calm before the storm. Or the calm before a sudden policy announcement in the middle of the night.
All right, listeners, get your pens ready. Or your mental notepads. It is time for the top 5 risks. This is your investor checklist for the week ahead.
Let's do it.
Risk number 1, the Fed policy pause or pivot on Wednesday. You said we expect a pause, so where is the risk?
The risk is the tone. We call it a hawkish pause. Imagine Powell comes out and says, we aren't cutting rates, and honestly, with inflation at 2.8% and growth at 4.4%, we might not cut them for a very long time.
Taking the hope of a cut off the table.
If he does that, risk appetite dies instantly. Stocks drop, yields spike. The market is priced for a dovish pause, meaning we're pausing now, but cuts are coming. If he kills that dream, look out.
Okay, so listen to the Q&A carefully. Risk number 2, sticky U.S. inflation, specifically the PPI on Friday.
Right. The producer price index measures inflation at the wholesale level. If this surprises to the upside, it means inflation is still in the pipeline. It's eventually going to hit the consumer. If PPI is hot, it confirms the Fed can't cut rates. It resets the entire board for bond traders.
Risk number 3, the Eurozone growth flash on Friday. What's the worst-case scenario here?
The risk is a broad-based contraction. If Germany, France, and Italy all post negative GDP numbers, the soft landing narrative for Europe is dead. It means they're in a recession. That rattles the ECB, the European Central Bank, and it might force them to panic cut rates, which could crash the euro.
Not good.
It basically signals the global economy has lost one of its engines.
Risk number 4, Japan's fiscal credibility. We talked about the bond vigilantes. What happens next week?
This is the sleeper risk that could blow up the world. Watch the JGB yields. If they spike higher, say past 2.3% or 2.4%, it could trigger global contagion. You have to remember, Japanese money is invested everywhere. U.S. treasuries, European bonds, Australian stocks. If yields in Japan get high enough, that money goes home to Tokyo. It gets sucked out of global markets. That causes rates to rise everywhere.
So a tax cut in Tokyo could raise mortgage rates in Ohio.
Exactly. That is the interconnectedness of the market.
And finally, risk number 5, China's consumer slump.
We are watching for a policy response. The data is bad. The risk here is inaction. If Beijing doesn't announce meaningful stimulus soon, and I mean handing out cash or massive support for the property market, the lack of support could lead to a sharp stumble in Q1.
And the market is waiting for that lifeline.
It is. If the phone doesn't ring, commodities like copper and oil could tank because China won't be buying them.
There you have it. The Fed's tone, wholesale inflation, Eurozone recession, Japan's contagion, and China's silence. It is a minefield out there.
Just a typical week in the markets, but really the margin for error is getting thinner.
So pull it all together for us. We started with Greenland and gold. We ended with structural shifts in China and bond vigilantes. What's the synthesis here? What's the one thing the listeners should take away?
I think the synthesis is that the post-New Year optimism has hit a wall of reality. The Goldilocks scenario everyone wanted, easy growth, low inflation, world peace. It isn't happening. Geopolitics are messy, policies getting complicated. Growth is there, especially in the U.S., but the risks are rising right alongside it. We're in a moment where you can't just buy the index and go to sleep. You have to watch the machinery.
It really feels that way. And I want to leave you, the listener, with a final thought to chew on this weekend. We talked about gold hitting $5,000. We talked about bond vigilantes in Japan demanding higher yields. These are both signs of the same thing. Distrust. If investors are flocking to hard assets like gold and punishing governments for borrowing too much, are the markets telling us something fundamental? Are they telling us that they simply don't trust the politicians to manage the economy anymore?
That is the $5,000 question. And looking at the gold chart, a lot of people have already answered no.
Think about that. Stay ahead of the curve, keep your eyes on the data, and we will see you next week for the Fed decision. Let the data do the talking.
Still watching? Then you're one of us. someone who actually wants to understand the markets. If this helped you think sharper, tap like, share the insight, and hit subscribe. Smarter markets need smarter minds. Let's grow this together. New AI-powered episodes drop every week. Imagine this format: AI-powered, sharp, fast, built around your industry, your firm, your market. For investors, leaders, or teams that move fast, we create custom podcasts designed to inform and impress. Curious? Contact us to build yours. Bespoke, bold, built by Flamingo's Research and Advisory.